more in the markets right now following the 11th record close of the year, the very short year at this point for the S&P 500. We want to bring in Elizabeth Burton. She is client investment strategist at Goldman Sachs Asset Management. And Elizabeth, thanks for coming in.
Thanks for having me.
So you keep seeing these new records. You keep seeing the trend that Mike was pointing to. If you were doing this as a portfolio manager, what would you think?
I think I would still be concerned about some risk on the upside in rates. I think I would want to stay invested in equities, but I would be thinking more about diversifying my portfolio. One thing that we've been talking to clients a lot about is last year I was saying you want to think about your geographic diversification. This year, I think you want to look across your entire portfolio and think about what sectors you're in, no matter what geography, no matter what asset class.
And what sectors are most at risk? The ones that have risen the fastest with technology or something else?
I think risk is maybe not the word I would be going for. It's more the concentration. So if you look at the flows in hedge funds, if you look at flows in general, you see a lot of money moving into the exact same things, right?
Yes.
Right?
Most of them, they have a really high technology. I think it was 25%.
Yes,
in the last quarter.
They've done well, so that makes sense. But when you talk about looking at other countries that you think might be interested in, like India, you might want to think about how much of that is also exposed to those exact same sectors. And I think it was okay to take a lot of concentration in sectors and companies and managers and bets pre-COVID when we had, a bull market in equities and it was hard to find additional sources of return. But right now, I think you need to be more aware of diversifying your portfolio and maybe being less concentrated.
Diversifying into what? Like what are the sectors that do look like they don't have enough money in them?
So I think looking beyond just tech as a long-term winner. So one area that might be is security, right? So cybersecurity, how many spam texts and emails do you get in a week? Food security, water security, national security. Yeah.
So all of these headlines on the geopolitical front weigh on you. Is that kind of the message?
They do. And I think it's one of, as an investor, it's one of the hardest things to hedge against. How do you hedge against, multiple countries and multiple issues worldwide? It's very difficult. You would probably have to put on multiple hedges. And it's actually something that we talk a lot to clients about lately. I would say in the last quarter, 2 quarters, the topic of hedging has come up quite substantially. And while that might be a good idea, and while the timing might have been right in January to start thinking about some of those things based on volatility levels, it's somewhat easier to think about diversifying across your entire portfolio, right? So if you want to get in really good shape, only one component of it is doing push-ups, right? So you got to think of other ways to get there.
What has the conversation with clients been this week after that hotter than expected CPI number, and what it means for what the Fed might do next?
It actually has been pretty muted, surprisingly. I think they're more concerned about what the terminal rate is than whether or not the Fed is going to cut by 25 basis points in March versus May. We think, they will start in May, although there's obviously some risk around that number. But they're more concerned about the long term, about where companies, are thinking that their costs are going to come in for long-term R&D projects. And that's really more focused on the terminal rate. And we still think that we're going to 4 by the end of the year.
This could be scary today if it was bad. I'm not saying it's going to be, but I think people wrote off that CPI sort of an outlier or seasonal. Yeah. People raise their prices January 1st for the year. No one really thinks that that's going to be the first of a long list of higher inflation numbers. They don't believe it. But today, if it was really bad today, that could, I think that we'd be back worrying about no cuts.
I think people are going to tell whatever story they want to tell, right? So CPI is made up of a lot of different numbers, and I think you have to look at a lot of different components, and I think you have to look at the trajectory in each of those components over time. And there were some seasonal factors, to be sure, but just this 1 month, I don't think is enough to decide what to do in March or May. We're going to have to see some trends.
What would be really troubling today, or what would be not so troubling today in the PPI? What should we look at services? What do we look at in the PPI to determine whether it's another hot number, or that there was nothing to worry about with the CPI?
Again, I just go back to, I don't know that this one number, no matter what comes out of it, is really going to be worrying one way or the other. It's the broader trajectory of where we're going. I would actually think more about what we're hearing from earnings and what we're hearing in those reports and what those are signaling to us and what the CEOs are saying. And take it from there. And I think what we've seen in those is, they're slowing down in labor practices, which, by the way, labor hiring isn't a bad thing. We still need to close a little bit of that job workers gap. They're also talking about how to use AI and supply chains. And the story on supply chains really hasn't been as bad as one might think, given some of the shipping issues. It's a relatively low of the cost in supplier input prices.
The consumer is very strong by most measures. You do hear a few things here and there. We've had some travel companies this week that have warned that the revenge travel looks like it's slowing down. We just had the head of the Consumer Financial, the CFPB, on saying that you're looking at $1 trillion in credit card debt for consumers at this point. Do any of those things concern you, or is this just kind of back to a normalization?
So investors are talking a lot about it, and we have a lot of conversations with folks about the consumer. And I would say if the investor I'm speaking with believes a recession is coming, that's one of the things that they're pointing to. Mm-hmm. But the situation isn't as bad as it may seem. There are a lot of data points that you have to look at. For one, the misery index has been worse 81% of the time since the 1970s, right? So. Okay. We'll see what Michigan says. But also, household net worth is in the 96th percentile, so that's pretty good. Yeah. And even on the company level, if we think of cost of capital, yes, it's higher now than it was in 2020, but it's not as high as it was in 2009 or 2012. So these might be sustainable levels.
Okay. And so your overall view for this year would be what, just in terms of where the market's headed?
I mean, I don't have euphoria for it, but I think there are pockets where I think we will see returns above cash. So I would say stay invested across asset classes. Most asset classes will return above cash. And so I would be out there and getting invested. And I think, the U.S. equity markets look relatively like a pretty good place to be.
All right, so to recap, Miss Elizabeth Burton from Goldman Sachs, she said, look beyond just tech for long-term winners. The only things she did list besides stocks were cybersecurity, food security, and national security. So she really likes security. She said maybe start diversifying, don't have too much concentration into one position. She says she's recommending putting some hedges on to all of her clients. She thinks rate cuts will start in May, not in March. She said this is one bad month of CPI. This does not change the trend. We need to see more data if inflation is sticking or leaving. So even though we've had some bad CPI data this week and this month, it's not changing the overall trend, but it may push back a meeting or two. We've got $1 trillion in credit card debt, guys, for the consumer. That is insane. Household net worth is still in the 96th percentile though, so somehow we're having our cake and we're eating it too. This year we will start to see returns above cash, so stay invested was her final note, guys. And I'm gonna leave you with that. I hope you enjoyed the video. Catch you in the next one.